Hello, and welcome to the Dr. Money Matters podcast, the show where we discuss important financial topics that were never covered in med school. I'm your host, Dr. Tarang Patel. Welcome to another episode of Dr. Money Matters podcast. In this episode, I talk with Eric Tait, MD, MBA, an internist and asset manager who started his own investment firm. We discuss why physicians need to achieve financial independence. Dr. Tait has a very well thought out perspective on the future of medicine, and we talk about how he separated his financial success from the practice of medicine. He was greatly influenced by working for an insurance company while he was obtaining his MBA. He realized how physicians are viewed as just another labor cost centers. As physicians, we generally don't think about how we are viewed by the people who actually pay us. Remember, it's not usually our patients who pay us, it's the insurance company. Eric then realized he had to become financially independent as soon as possible and developed a systematic approach to achieving this. As physicians, we generally do this when doing a procedure or reaching a diagnosis for our patients. And I think it's a valuable skill to transfer over to the investment world as well. Ultimately, Eric chose real estate to achieve his goal of financial independence, but he talks about how he analyzed the different asset classes that are available and how he came to real estate to achieve this goal. We briefly talk about his views on cryptocurrency and then about how his investment fund works. We finally discuss some of the successes and mistakes that he has had as an investor. It's great to see our fellow physicians taking charge of their own financial future rather than having it handed to them. And I hope this episode inspires you to do the same. Okay, welcome to another episode of the Dr. Money Matters podcast. My guest today is Dr. Eric Tait, a practicing internist in Houston, Texas, who also has his own asset management firm, Vernonville Asset Management. Eric, welcome to the show.
Thank you so much for having me. I appreciate the time.
You're in Houston. I hope Hurricane Harvey didn't affect you too badly.
We got lucky kind of in our main house in Houston. Our garage flooded, came up to our door, and then receded. We were fortunate some of our neighbors ended up getting flooded. And our neighborhood is close to one of the bayous, so it usually floods in the streets, but not into the homes. So we had some damage in the neighborhood. And then some of the investment properties that we have, we got very lucky because we have them fairly spread out geographically in Houston. And only one of the homes actually flooded completely, but it had flood insurance. It was in a floodplain. So I just got the settlement from that. And so we're in the process of rebuilding that, and everything else we pretty much have fixed at this point.
Wow. That's great because I know a lot of people are going through some hard times there, obviously Miami, Florida, and Puerto Rico. So I'm glad to hear that you guys kind of, were able to handle it and you guys got the insurance settlement quick. That's awesome.
Yeah, we're lucky, but Houston still has a ways to go. People don't really realize that over 100,000 properties have been affected, and some people have lost everything. And so for people who are still donating, please, there are still many, many needs in the Houston area.
Unfortunately, all these things happen simultaneously, one right after the other. And I think people forget exactly that while the damage happened first, it was a pretty significant amount of damage. So absolutely keep Houston in the back of your mind as well, and all of Texas Gulf Coast there. So let me ask you, tell me a little bit about your background. You're practicing internist, but tell me about your training and then what kind of got you into the financial world.
Oh, absolutely. So originally from Mount Vernon, New York, suburbs of the city, went to college in Atlanta at Morehouse College, then came to Houston, did a dual degree program, MD MBA program at Baylor College of Medicine and Rice University, then down to the coast in Galveston for residency at UTMB Galveston, and then practicing internist. And really it all started in business school when I had taken my first kind of accounting classes and really learned how the stock market works and how we practice capitalism here in the United States. And it left me wanting. And so I really went on a journey to really invest my own money. That's really why I went to business school. It wasn't really any more complicated than, I was going to be a doctor. My wife is a physician. And where were we going to put this money that was going to ultimately benefit us as soon as possible? And so it really was no more complicated than really just a biology major trying to learn finance kind of on the fly.
So you had the interest. Physicians are notorious for not being very financially savvy. So you went to business school concurrently with your training. So talk a little bit about what you learned there that gives you an advantage over the average physician.
Not so much advantage. I would say more of a reality check. So my concentration was in healthcare management and entrepreneurship. And so one of the things that I worked on when I was between first and second year of business school, when you're doing internship, is I worked for a large, well-known insurance company back in the Northeast. And I worked as a network medical director and actually got published doing some of the early pay-per performance trials. And so this was summer of 2001. And so if you understood where the tea leaves were, you understood what was happening in medicine. And so the biggest thing that I realized was that in medicine, we tend to be in our own bubble and we tend to be the captains of the ship. But to the outside world, especially when it comes to resources, resource usage, resource allocation, the amount of GDP that's being spent in our field, our importance as it relates to the system is not either understood or respected outside of medicine. And that to me was the biggest eye opener and led me down the pathway of how I looked at finances, because I always wanted to be a physician. I went to college, wanted to be a physician. My uncle wanted the same college. He was a physician. We have other family members that go back who are physicians. And so that did not change for me. But the understanding that physicians don't control the system, even though the system doesn't work without us, I knew that I couldn't be financially tied to that kind of model, which basically meant I had to divorce my financial life from my professional life. And that's not something that most physicians have ever historically had to consider, and one that ultimately, because we're not trained in it, can be very disconcerting.
Absolutely. So this is a very interesting mind shift that I think some physicians now are really starting to feel a little bit more, but you had this realization probably at a much earlier stage than most of us do, because like you said, most of us are so focused in on getting through the medical school part, getting through your residency, and you're so focused in on the training that it's sometimes hard to grasp the external factors that are occurring outside of your little silo that you're in. So once you realize that this is the new reality for physicians as a whole, at what point were you in your career and what kind of steps could you take at that point to, like you said, you divorced the financial aspect from the reality that you've discovered there?
It was pretty early on. And so I was fortunate that I had mentors early on. And between my first and second year of medical school, we had a lot of elective time. So I did an elective with a community-based physician. Eventually became a mentor of mine. I actually went and practiced with him for many years right out of residency. And I watched basically his life trajectory and kind of how that unfolded, always with the backdrop in the back of my mind, understanding that, okay, he lives a pretty good life, but I see these forces that he can't control that are around him. And the greatest thing that business school gave me was an understanding of systems, right? Systematic thinking when it relates to just providing services for people. And the biggest light bulb was really the understanding that if your client, patient, whomever is not the person paying you, then the market itself, everybody likes to talk about market forces, then the market doesn't really matter, because the people who are the beneficiary of your service don't determine your value, which is what it is in any other business. And that's why I tell people medicine is not a business. At best, it's an indentured servitude, because as long as you're in a third-party payment model, someone else is always going to determine your financial worth, and someone else is going to determine how you practice. And so most of us went into medicine with very idealistic ambitions and endpoints. And it's not just about the financial side. It's also about the actual how we practice and how we actually take care of patients is really dictated through finances, through the payment model. And so understanding that and getting early introduction to that as a med student always let me understand, as I was going through training, I always watched what was happening on the insurance side, on Medicare side, on the Medicaid side, because I knew it was going to have a direct impact on how we were going to ultimately practice.
Let's talk about that, because again, like you said, you had that realization pretty early on. So what kind of steps did you take, maybe while you were in residency or, when you first got out, to ensure that you would not be necessarily tied to just practicing medicine as the way you're going to make money the rest of your life?
So what I did was during business school, I went on a quest for what I like to say business models. So what business models out there could keep me financially stable while being a physician? A mentor says medicine is a jealous mistress. Most of us don't have a whole lot of extra time if we're going full bore into practice. And so, I had to look at and figure out, okay, if let's just say I'm practicing 100% of my time, 60 hours a week, my wife and I, what ways could we invest and make money in that process? So we went down the stock trading side of things, right? But I'm in business school, so I learned kind of how the stock market works and realizing that underlying market fundamentals of business does not determine stock price. Then you learn about the capital asset pricing model, and you learn about all the inefficiencies that are there, that really emotion rules just as much as how a company's actually doing, and sector rotation, and what hot money is moving into what sectors and how that moves the market. So to me, that rationally didn't make a lot of sense to put a lot of my wealth there. So then you look at, okay, what about franchises and things of that nature? But if you look at some of the major franchises, you have to have a lot of at least initial net worth, and then you have to spend a lot of time figuring out and being in there. So I won't name brand names, but many of them have their own schools and universities that you have to go through. I was like, well, that's not going to work. And so then I just said, okay, where in the world is most of the wealth held? And so for me, the easiest and lowest hanging fruit was just real estate. And so I had happened to buy a condo when I was in medical school. And then I just said, well, let me just rent it out while I'm in residency. And once you get that first check that you don't actually have to work for, it's very addicting, I should say. And so once you begin to get paid without you having to constantly put your labor in, and don't get me wrong, we work hard in trying to find projects and those kinds of things. But when you can get paid and you don't have to keep putting in labor inputs for it on a consistent basis, at least that is a full-time kind of job, it completely shifts your mind. And so then I went to search for things where I could either leverage my medicine degree, being, okay, I'm a physician, that allows me access to these particular projects that will generate income, or hey, what other kinds of businesses and what real estate or these types of things can I invest in that are going to generate income without me having to physically do that work on a consistent basis? And so it really just started with a 2-bedroom, 1-bath condominium when I went to residency.
Okay. I think the real estate, especially, single family homes or condominiums, things like that, is a pretty common model for people to think about as alternatives to stock market investing and traditional equities and things like that. But then you mentioned something else that I think is interesting. You mentioned what you could do as a physician, what kind of access that you had as a physician. Tell me a little bit more about that, because anyone can get into traditional real estate investing.
Let me do the caveat emptor on the front end. So many physician projects, we're the dumb money in the deal, meaning, the dumb doctor deals, right? So you have to be very careful about that. The greatest thing, I'll be honest with you, the greatest thing about business school was learning income statement, balance sheet, and cash flow statement. Now, you don't need to go to business school to know how to read those. You can basically get it off of YouTube. But I don't want doctors to run headlong into doctor deals, right? There's more money lost than probably anything else in the world. But there were the ability to leverage, what I like to say is leverage our labor, because I like to divorce my lifestyle from my labor, which is why I like passive income. But if we're going to be physicians, there are ways that we can move up the economic value chain. It's harder nowadays than it used to be. But when I had the ability to invest in the main hospital where I was practicing, and I did this when I literally first got out. Looking back, it wasn't the greatest deal in the world, but it gave me some tax breaks, gave me some other things that were beneficial, and gave me some experience as well. So being a physician at that hospital, we had the ability to invest in that facility. And based upon the original management team and what their plan was, which they weren't able to accomplish, but based upon the plan, I was willing to take that risk. Now, I'm not saying go out there and invest in hospitals, especially full service acute care hospitals. Their capital sucks in terms of the amount of capital they need to keep running. But I was early in my investment world. It gave me the experience to understand that. And so that was put onto my experience resume. There was an insurance plan that came into the city. They wanted to partner with physicians, which allowed us to sit at the table and see the money come in from, it was a Medicare Advantage plan. So we were able to see the money come in and filter through the plan and then be distributed. And so we had a direct hand in being able to create our own networks. And that was invaluable. That's probably been the best investment I've ever made in my life, in all honesty, in terms of the total return that I've gotten for the amount of money we put in. And so I was going to see those patients anyway. I was still going to send the patients to the hospital I was going to do anyway. I looked at projects that did not change the way that I practice medicine to try to lever up my ability to move up the value chain. Now, I was not one who brought in new service lines into the practice just to make more money. I don't like changing my practice patterns for revenue's sake. I don't begrudge anybody else who does that as long as they're within guidelines. But anytime you have the ability to take the labor you're already doing and move up, because as physicians, we're at the bottom of the food chain economically. We get what's left over after everybody else is eaten at the trough, in all honesty.
Go into a little bit more about that, because I think that is a difficult concept for most physicians, particularly ones who are just fresh out of training or in training, to understand. So tell me a little bit more detail about that.
Essentially, we're labor. Now, we have a professional code. We say an oath. I mean, there's all those things, right? But ultimately, at the end of the day, we are labor. And we are labor, and the people who avail themselves of our services do not pay us. So that means that there's a massive disconnect because we do not control the dollars that flow into the industry. So if you're a business person, you control the dollars that flow into your company. We as physicians no longer control the dollars that flow in. That's our predecessors controlled those dollars, and they abused that privilege. And so the government and private insurers took the purse strings away from physicians. We're never getting the purse strings back, right? And so because of that, we are well-paid labor, but we are labor nonetheless. And especially as we think about these payment models in the future that are not going to revolve around fee-for-service. And so if we're talking about a bundled, global capitated payments or global payments that surgeons get, that's a form of rationing, right? It's a form of economic rationing. So let's take the ACO models. The ACOs, the money comes into the system, and then it filters through. And then if there's anything left over at the end, then that will get kind of distributed. Well, imagine that whole model across all of medicine. I'm personally, and I have no insider knowledge of this, but I am personally convinced, and if you look at the tea leaves, that we are being pushed into employment models to better control our behavior. We're going to have to all pick teams that we're going to be on. In each of the major cities or regions, you're going to team up with a large entity of some kind. Some of them will be physician run. Some of them will not be. And the money's going to come in and flow at the top. And then it's going to have to be distributed based upon some value system to take care of all the patients. So it's going to really move to a population-based model, I think. I can't say it's going to happen tomorrow, but ultimately, in the end, we are just part of the team in that process. We are not going to drive that process.
I think you explained that very well. I think that's one of the toughest things because, as you said, we all went into medical school idealistically to take care of patients. And that's, of course, what we still are doing. But traditionally, we were a much more valued part of the team, whether not just financially. And I think that's being denigrated a little bit. And also the control aspect is obviously being taken away. And I think that has contributed a lot to not just the financial issues that physicians face, but also a lot of this burnout that physicians are facing because that those powers and the control aspect is being eroded away over time. But anyway, I don't want to get too far along into that part because I have had other shows about that aspect. But I think that, so that being said, you basically mentioned that that's why it's very important for physicians to achieve financial independence as early in their career as they can. And real estate is one way that you've done it. Let's talk a little bit about some of your experiences. Well, as you founded Vernonville Asset Management, your investment company, what you've done with that, and then some of the deals and things like that you've done as part of that company.
Oh, absolutely. And it's not just real estate because we have other investments as well. Really, my mindset was more so one of cash flow, right? And I don't want people to think that, oh my God, I've got to replace all of my income before I can be financially free. That's not the case. I've always argued if I can cut physicians basically their workload by a quarter, just replacing whatever that missed income would have been, that you'd reduce the epidemic of burnout immensely, right? So it's not like you're trying to replace all of your income, because if we just could ratchet down the amount of work that we're doing as physicians, you'd have a happier populace of physicians. And I think that would translate on a metaphysical level to a healthier society, because what's it to say about a society when its healers are all disgruntled and more than half of them would leave the profession if they could? And I also want to say on the real estate side, real estate is just a means to an end, right? In the end, there's no magical quality to it. The magical quality about it is that there are tax laws written specific ways. Banks will give you 80% of the money to buy these assets, and you can put your individual investment dollars can go further, and the natural market forces of inflation help you. So if I could do the same thing with stocks, if I could do the same thing with bonds, and there was a kind of milieu that allowed that, then I'd be all in those things. Really, it's just, for me, real estate is the highest and best use of the dollar to achieve income replacement. But if you can find a business to get into to do that, and you have the requisite knowledge of understanding how to evaluate that business, then do that. Again, I just think that real estate is the easiest thing, right? Because all of us have a passing familiarity with it. We've all lived in something that can be rented. And so that's how I started. It was just, I wasn't a tech guy to say, hey, let's go do VC stuff. I was like, well, I can understand this. Let's do it. So we just bought single family homes. We bought small apartments all through the downturn when people were running from real estate. That's where understanding what you're investing in is so important, because during the economic downturn was the best time ever to buy pretty much anything that had solid economic footing. Americans, they like to buy everything on sale except for real estate. So we backed up the truck. Now, in hindsight, I would have backed up the truck on apartment complexes, not on single family homes, but hindsight is 2020. And so we did single family homes, apartments, and then in roughly 2013, 2014, we just had some physician colleagues who wanted to join us and see what we were doing. And I talked to a securities attorney. He said, hey, just all you have to do is let the SEC know your investors need to make X amount of dollars, which as physicians, it's really not an issue. That's the whole accredited investor piece. And we can go into that if you want to. And we just decided to start doing larger projects, because what I found was larger projects actually tend to be safer because you have more eyes on the deal. Any of us can go out there and buy a single family home or a condo or even a small apartment complex. When you're buying a 100-unit apartment complex, when you're doing a 300-room hotel, you've got a lot of experts in the room looking at it to say, hey, what's happening? What do these numbers look like? What are your contingency plans? And so you have a built-in team of people who are already going to be looking over your shoulder in that process. And so that's really kind of the natural progression of most real estate investors as they start kind of on these small individual things, realize I don't want a million roofs to deal with and AC units and those kinds of things. I'd rather just be in a larger project that has better economies of scale. So we just took that natural progression up and then brought in outside investors along with us. But ultimately, Vernonville is how I invest my family's money. I just allow other people to come and join us on the ride.
So you mentioned that you basically went from, like a lot of people start out with single family homes, smaller apartment deals. And as your asset base has increased, your own as well as outside investors, you've started getting involved in these larger deals. Can you talk a little bit about some of those deals?
Oh, yeah. I mean, so we are larger apartments. So I will say to have professional management, at least in the markets that we're in, you need to have 85 units or higher. Some would even argue 200, but you don't have to go that high. And then also right now, because real estate in the United States is pretty well fairly valued, it's not really in a bubble, but you're not going to get a discount. But if you're looking for something to get a discount, you're going to have to buy something that's crappy and you're going to have to fix it up. We're in the process of a major renovation on an apartment complex here in Houston. And, that's one model, right? And that gives great tax breaks. It has the ability to lever that up. But then you don't always want to be in heavy lifting kind of projects. And then for me, I didn't also want to be just tied to the United States. Some people think investing outside the U.S. is risky. I would argue that having all of your economic eggs in one country's basket, one political system's basket, and one currency basket is risky as well. We started to look across the globe to see where we could invest that has basically the same laws around property that the U.S. does, and that's British common law countries. And then also we're on an earlier growth trajectory, because in the end, if you're only going to make a 4 or 5% return, you might as well just buy AT&T and get their 4% dividend and call it a day. If you want to get a higher risk-adjusted return, you're going to have to go into markets that are growing faster than the United States. For us, we wanted to get exposure outside of the U.S. as well, because we diversify across asset classes. I don't diversify and say, hey, I'm in the stock market here, then I like real estate and private businesses. So I'm going to diversify in those assets across geographies and political systems and monetary systems. And so we're in a hotel project down in the Caribbean, and we're also doing farmland down in Central America, income producing farmland. We try to spread our assets across many geographies and across many asset classes, as long as we can own the land and there's a good cash flow stream behind what it is we're doing.
Let me ask you this, because this is a tough thing for physicians to do. Like you had mentioned earlier, many deals for physicians, you said dumb money, but we're basically the capital, and whether it's a good investment or not, we just don't know really how to evaluate that. So when you're looking, and then you're adding in another complicating factor, which is not in the US necessarily, which is, I agree with you, which is great for diversification of risk purposes and probably a much better chance to get good returns. But how are you able to evaluate those kind of deals? Obviously, that's a very difficult question to answer in a short time span, but
it's actually one that I've turned on its head. So let me turn it on its head, and then I'll tell you how we do the evaluation process. So if most docs, if they're doing the traditional boglehead or white coat investor, those things, they're in index funds. Well, 60% of the money that's made in the S&P 500 is made overseas. So by default, you're already invested overseas. That's number one. And more than half of your earnings is coming from overseas. So you're already a foreign investor, right? Many of these companies are not even domiciled here anymore. So people are already doing it. They just don't even understand that they're doing it. That's number one. Number two, there's nothing that I invest in that I myself have not gone to either the country, the place, or what have you multiple times to actually walk and be and spend and do comparative market analysis. There's no project that I myself have not walked and have not gone to that place and been in that place or have ties to that place in some way, shape, form, or fashion. And so I end up doing more due diligence than the person who owns an index fund. Most of the time when I'm talking to investors, I know more about the portfolio that they own than they know themselves. And that's just because I went to business school. I follow the stock market because I have to be well versed in everything my investors are doing. So when they come to me and say, well, what's going on here? What's happening here? I tell people all the time, don't put your money in anything that you can't fairly value yourself. So if you can't tell me what price you're paying for something, why are you investing in it? And so I turn the assumption on its head. I can give the valuation for any project we do. I can show you what the valuations are. I do an hour-long presentation to any investor as to what it is, what the inputs are, where the revenue's coming from, what the threats of it are, what I like to call a sensitivity analysis is. So if we're looking at this occupancy versus occupancy. So in the end, I always tell people you're going to know more about a project that you're not even in than what's probably in your own portfolio right now. And that's incumbent upon me as the person putting the project together to teach. And I would say anybody who is asking for your money or anybody who is saying, hey, yes, you can come in and join us, if they can't give you that confidence that it's clear that you understand how it's going to work and how it might not work and what the threats are and what the opportunities are, you shouldn't be investing your money. And I believe that's for your 401k, your IRA, and all of those things.
Right. That's a good answer. I think you're right. And it's not necessarily a bad place to put your money, the stock market and index funds. I think it's the best on average. If you don't want to have much to do with it and don't want to do anything, I still think that's a good place to be. But I do think that most people don't realize the risks and most people don't realize what they're holding. It's just kind of what they've been told to do. So that's a very, very good answer. Let's go into a little bit more about you mentioned you don't just do real estate, and some of what you do is what's considered alternative investments. What does the term alternative investment mean? And what place does that have in most physicians' portfolios?
It's actually an oxymoronic statement, right? So historically, anything that's not typically in the public market, stocks or bonds, is considered alternative. But let's think about that realistically, okay? So when I say we're going to buy farmland or a home, if you really think about it, that's kind of real, right? It's not alternative. It's the only thing that, 5,000 years ago, the things that we're talking about buying, people bought. 5,000 years ago, people weren't buying stocks. They weren't. It's really what I call the Wall Street indoctrination process, right? So they want everyone to think that just passively investing in these paper slips is what's normal and what is safe. And that anything else that is not that is alternative and it's risky. And so it's really a marketing play more than anything else, in my estimation, about how they set up in people's minds the ability to continue to keep capital for themselves and not allow people to have control over their own capital. And so pretty much anything that's not stocks and bonds is considered alternative. So we're talking gold, we're talking about commodities, we're talking about real estate, we're talking about private equity, VC investing. All those things are considered quote unquote alternative. Now, the ironic thing about it is oftentimes to be able to invest in those quote unquote alternatives, you have to be of a certain wealth or income status. And so interestingly enough, and it's funny, the president just put out a tweet, you all's 401ks are not going to be touched, great middle class vehicle. And I just look at it and chuckle because that's exactly what it is. It's a great middle class vehicle because wealthy people don't use it. And so from that standpoint, the wealthy are all in alternatives, right? If you look at the Tiger 21 Club, which is a professional investment club with branches around the country based in New York, if you look at their allocation for the third quarter, it's 54% real estate and private businesses. It's less than 20% public equities. And these are people with investable assets of 10 million or more. And so if you actually look at it, and it's just go to tiger21.com, they list their portfolio allocations. And, the really wealthy do not do what the middle class and upper middle class do. And that's just a simple fact, right? So I'm not that smart. So I just do what the real wealthy people do, right? I'm going to mirror their asset allocation. And for me, it has worked out.
Good. Well, okay. So let's go a little bit into that because it's worked out for you. But let's say I'm a young attending, couple years out in a primary care field, making high middle class income because this is obviously not elite level money. I still think that investing, in your 401k and things like that for the tax purposes is a good idea. But what point should I start, looking into these alternative, quote unquote, alternative? Because I agree with you. I think there's very good investments to be made, but maybe they may not want me because I'm not quite at that level yet. So how do I look for these things? Obviously, your company is one, but how do I look for these things? And is that the right time for me to start investing in that?
I got this from a mentor of mine. You've got to start with your personal investment philosophy. You've got to figure out what you want your financial life to look like. What do you want your resources and your assets to do for you? You start there because I tell people, I don't ever tell people what to do. I can just show people what I do and give them a rationale behind why I do it. And if it resonates with them, cool, come along. We'll see if from a personality standpoint, if you fit, right? Because to me, that's more important than money. You could have millions of dollars, but if we're not going to fit personality wise, we're not going to float. So we're going to start there, right? What do you want to do? Because you can't get somebody who grew up either working class or lower middle class who now comes into money. So now money has a whole lot of connotations around it. There's a whole lot of psychological baggage. And then if you have a spouse, there's baggage on that side potentially as well, good and bad, right? And so ultimately, it's about going within yourself. One, trusting yourself. I'm big on potential investors trusting themselves and trusting their guts, not we're all very highly schooled professionals with a decent amount of common sense to get where we are. So I want people to trust themselves first and foremost, and then really sit and figure out what it is they want. And if what they want is not going to be accomplished by doing what they've been told to do, they have to decide that if the ultimate outcome of that is psychologically scarring enough to want to change and do something different. Because to do the things that we do, we have to stand alone, right? When I tell people I don't have 401k, I don't have IRA, they look at me like I have three heads. And so you have to be willing to stand apart from everyone else to say, you know what, that's not the route I'm going, right? And so I don't want anybody suing me. So I'm not telling people what to do. But having a clear understanding, what I wanted to do, I said this, we have a baseline expense ratio in our household. We're not going to go above that. If we want to improve our lifestyle, then we're going to have to buy assets that increase our income without us having to work harder. And so every dollar that was above that baseline expense of just, paying our loans and paying our mortgages and doing that goes towards increasing our income. And That's just our personal investment philosophy, right? So either it's going to give us a tax break so we keep more of our money, or it's going to generate income. That's just our philosophy. Start with a philosophy. Before you get a financial planner, before you start doing anything, figure out what you want your money to do for you. Because people do the mental fallacy of mental accounting. That's a kind of economic accounting fallacy. You don't have 401k money and 529 money and savings account and checking account. You have capital. And that capital is all the same. You're just categorizing it into different things and saying it has different jobs. It really doesn't. It's all the same capital. And it can all do the same things for you. Now, of course, you need to have a savings. And I tell my investors, you cannot invest with me if you don't have disability insurance. And if you have kids, if you don't have term life insurance. You must protect your income first before you can do anything else. But after that, it's completely up to you. It's completely up to you. And so that's how I built my life. And then I think every investor should do that before they do anything with their money, is figure out what they want their money to do for them and what kind of life they ultimately want to live. How long do you want to be working? How long do you want to be working full time? All of those things. And then figure out, are you putting yourself in a vehicle that can make that actually happen or not?
I think that's a great answer. And it's really important to get the mindset like that you're describing before you do anything, because most of us are just, you come out, you do your training, you do your work, and you save a certain percentage and blah, blah, blah. And, that's it. But you're absolutely right. The thought process that you're describing there is invaluable. And I think that most of us would do well to really understand what we're doing, what we're working for, why we're doing what we're doing before we just commit ourselves to a career of doing that and just kind of blindly following it. So I like the way you describe that, because if my listeners take one key point from this, I think about what you're doing, why you're doing it, how you're doing it, and where you want to be. I think those are the things that you described that, will be key to their financial success and more than just financial, but a successful life in many ways. Let me go into this. This is just a more specific question that a lot of my listeners and then people, my colleagues have been talking about recently. And that's Bitcoin and cryptocurrencies. It's just one of these things that has come up recently. There's all this talk about appreciation of cryptocurrencies and stuff. What are your thoughts about that?
I have not studied it in depth, so let's start there. So I can't say I have a super informed opinion, but I always try to look at the world through principles, right? And so specific principles and things of that nature. I have different thoughts around cryptocurrencies based upon what someone is trying to accomplish with them, right? So I believe they're probably great trading vehicles. You can trade them kind of like a quantitative trader on price action. So I think they're great for that. I don't think that they're a long-term investment. And my rationale around that is there's really no limit to how many cryptocurrencies can be created. So you have no natural supply breakpoint that I like to see in investments. I like to invest in things where there's an increasing demand and a decreasing or static supply. And I just don't know enough around, like I'm talking to a friend who's a miner, and he says essentially blockchain and Bitcoin have to go hand in hand. I'm not convinced of that necessarily. I don't know if blockchain technology has to, but he's an expert more than I am. So he tells me that, then I might have to go with it. But when I see all of these big companies saying that they want to create platforms, and the issue is computing power, which, if we know, Moore's law. So if all I need is a ton of network computers around the globe and enough power that I can create a same kind of model, then it's like, okay, there is no natural breakpoint. I don't see it as a worldwide usable currency. Worldwide usable money, because money has some very specific characteristics that we won't go into here, but one of them being intrinsic value. And so there's no intrinsic value there of any kind whatsoever. And so I think it's perfectly fine to trade the stuff and to speculate in it. But in terms of just putting it and setting it and forgetting it, I don't really believe in any setting and forgetting it unless you're getting paid on a cash basis. So I don't even believe in setting and getting it for stocks, right? We'll do it somewhat in real estate, but even then, we can get paid to ride out dips. So from that standpoint, I don't think it's an investment. I don't think it's money. I think it can be currency, and I think it can be traded.
I agree with you in the sense that I don't invest in it myself. I don't have a very strong understanding of it. I understand that Bitcoin, the currency itself, has some theoretical limit, but I just can't see why there's all these new flavors of cryptocurrencies have come out. And I just don't see the inherent advantage of Bitcoin or one of these above each other. And so I'm sure newer and newer cryptocurrencies will probably have additional features. And so I just don't see the inherent value of it yet. I like the idea of a decentralized currency and digital transactions, but I just don't see that one of these has a dominant position. But like you said, it can be traded. People who have bought it in the last few years have done incredibly well. But as far as long term goes, I just have no idea what the future holds in terms of cryptocurrency.
Yes, hopefully those that have made money have taken their money off the table and they're just playing house money.
I would agree. I would agree with you totally about that. Let me go to a last thing here. I don't want to go on too long with this, but I want to talk a little bit about your fund or your asset management company, Vernonville. Since you started it in 2007 as a private investment for you and your wife, and then you opened it up, like you said, later to outside physicians, your colleagues. What kind of performance have you had since you've opened it up to other investors?
For outside investors, most of the projects that we have done at this point in time have been kind of either new builds or renovation projects. So the returns are mostly going to be capital gain wise. And so it's not, I don't discount capital gains, but we tend to lead with cash flow in terms of what we put out there. And so I would say, let's say in our hotel project for the early investors, we're probably up 35, 40% on a capital gains basis. So that's probably 12 to 14% from that standpoint. If we count the little bit of tax loss we've been able to give just from depreciation, maybe a couple ticks higher than that. On our apartment project, from a capital gain standpoint, I would say, I so don't count capital gains, so I'd have to go back and look. But I will say that on a tax basis, there was about a 27% return last year, just from the tax loss we were able to give from that standpoint. And then we've just done the farm fund, and so we haven't had our first harvest yet with that. So nothing there. And that fund we just opened maybe 2 or 3 months ago.
Okay. So are people investing as just as a set amount into Vernonville and then you divide it up, or are they investing into individual projects within Vernonville?
Great question. So right now, because we're relatively early and I'm not asking for that much trust from my investors yet, we are not doing what would be considered a semi-blind pool where the money just comes into Vernonville and then I allocate it as I see best. That's a lot of faith. Now, granted, that's what people do with mutual funds, but we won't talk about that now. No, actually, investors get to choose. So we create Vernonville is the management company, but there are actual individual investment funds under Vernonville. So you get to decide, yes, hey, I want to be in that hotel project. Nah, I don't want to be in the farm. Yes, I want to be in the apartment. So people get to choose what they're in. So it's very much a menu. You can say yes, this, no, yes kind of situation. So you know exactly what you're investing in. I don't have that much latitude in terms of taking the money and saying we're going to do X, Y, and Z. We do a min-max raise on a very specific thing.
And so on the flip side, let me ask you this: what is a financial mistake, whether it's a stock trade or a real estate investment that's gone bad that you've learned something from that's kind of changed your philosophy or reinforced your philosophy?
Oh God, how long do we have? Okay, so the hospital project that we didn't put a fund together, that was just my money into a project. I learned about capital efficiency and the lack thereof for in hospitals and big kind of projects like that. And so you're always going to be competing with dividends versus capex or capital expenditures to maintain the facility. So I learned to look at projects that had capital efficiency in them in terms of what we're doing from a real estate perspective. So not a lot of extra incremental dollars to maintain the asset. Then we had a real estate deal that didn't go well, no outside investor money. This was my own money. Right at the peak of the market, we were buying condos that we were using as kind of personal care homes for people who were drug addicts or who were mentally challenged. And so that project, couple of mistakes on that project. One, the person we were buying from had some other financial issues. They had cross-collateralized the property with other projects. And so as we were buying it, he lost control of it, lost control of the insurance. our insurance went through the roof. It just got crazy from that standpoint. On the flip side, the person who we were using as the manager to bring new clients in, she wasn't very reliable and didn't have a good source of steady clients. And so that let me understand from an operational standpoint, one, you need to control the whole deal from outset. So on the top side, the bottom side is you have to have experienced operators if you're going to be in an operations type business. So an apartment complex really isn't operations heavy. A hotel, an Airbnb is operations heavy. Going into those projects, you have to make sure that your operator has a platform on which to really get clients through the door. And then stock trade, we invested in a private bank that was targeting the Hispanic community in North Carolina right before the downturn. So once real estate dried up, that bank dried up, got subsumed by another. Again, this wasn't something I put outside investors in from that standpoint. So I can go on days and days and days and days.
We get it. Everyone makes mistakes, but a lot of times you only hear about the positives because obviously that's what people want to talk about. But it's good to know, that everyone's influenced by both sides, successes and failures. And as long as you're learning from the failures and can admit to the failures, then I think that's an important trait in an investor.
Oh, absolutely. And I will tell you, I asked that question of my prospective investors because they have to understand that there are going to be ups and downs in this. And so I'm very upfront. I asked them, what has been your biggest failure in your life and how have you overcome that? Because if no one has had a major failure, I don't want you in my project because we're going to have issues. They're going to come up, right? And I need to know how you react in the downturn, right? I need to know how you're going to ultimately be. What is your temperament like and how you answer that question? And so I think, so anyone who knows me, who's invested knows that I ask that question back of potential investors.
Good. I think that's actually a really good point is that we want to know from you, but you also, like you had mentioned earlier, when you're talking about developing that mindset, that's a question that you should definitely ask yourself before you do anything else. But let me see, you kind of touched upon this topic a little bit when we were talking about the performance. But for the average investor, for average physician, what's more important in your mind, cash flow or appreciation?
Loaded question. Depends on what they're trying to accomplish. And so if you've got a high income earning physician who loves their lifestyle and is in a cash pay business, let's say it's a dermatologist or a plastic surgeon, got great income, and they're like, well, I'm really trying to set up for my kids and great grandkids and set my estate together, then it's going to be appreciation all day long. And we would put them in a project that's an appreciation heavy project. And if it's the everyday person who hates their job and is like, listen, I need to get as free as possible, then it's going to be cash flow. And so it really is. And anyone who talks to me understands. In my company, it's not about me and our projects. It's about the prospective investor and what they're trying to accomplish. Because oftentimes we won't have something and I'll just have to refer them to my friends who are also syndicators and say, hey, this is what they're looking for. Look at this, call them. They'll have something for you. Because in the end, it's all going to come around. And so that's why personal investment philosophy and looking at your whole financial picture as a whole is much more important than trying to find a deal. Deals are ubiquitous, right? What I would argue investors are trying to find is someone that they can mentally vibe with, that is going to give them what it is they're looking for in terms of help learning about finances and learning about those types of things. To me, it's more important that you're going to find someone that you can grow with than it is to say, here's the best deal out there and this is what I think the best project is and these are the numbers. This is a relationship game. In the end, what my investors have is the ability to call me up on the phone and ask what's going on and then also have my Rolodex at their disposal. And so that's very different kind of situation than kind of sight unseen type of investing. And so that's why I would say it's really about what you're trying to accomplish. And then you will then gravitate towards the projects that will give you that. And the person you're sitting across from, whether it be a financial planner or an independent person like me, should be going through this with you to say, listen, what does this look like? What do you want to do? What is it? Where is it that you ultimately want to be? And then we'll put you in the thing that does that.
Good. I think that's some great advice there. Let's go outside of the financial world. So you mentioned when we were talking a bit earlier that you're still working in your clinical practice and you're also running Vernonville. What do you do with free time? Do you have any free time?
Well, I wonder if I should tell on myself. So right now I'm sitting in my pajamas, looking out the window, talking to you. And after I leave here, I'm going to go exercise. And then let me actually look at my calendar. What do I have left? Then I have a meeting at 6:00. So I see patients 1 day a week. And then because I have income coming from multiple sources, I don't have to do investment projects to make money. So I only do investment projects that move me and where I want to place my money. And so I don't think I'm going to take on another project for the rest of the year. We've got a couple of funds that we're going to finish funding through the end of the year. And then we're going to then sit at 2018 and have a strategic plan and figure out what it is we want to do for 2018. So I actually end up I am busy, but I am busy based upon my own schedule. I set up when I'm going to be busy. For me, the whole point of investing was to have time freedom. Didn't mean I was going to retire. Didn't mean I wasn't going to still work hard. What it meant was I could structure my life in a way that I wanted to structure it. And so that's really, for me, I have the ability to, I was at my college homecoming this past weekend, going down to New Orleans for the New Orleans Investment Conference to kind of see what's going on in the mining and metals space. And so I'm busy, but I'm busy in the things that I want to be busy in.
Awesome. Well, Dr. Tait, I think that's where a lot of us are trying to get, and I congratulate you for being able to achieve that in a very relatively compressed time schedule. So awesome. And I think that you gave us some really great advice, and I think that our listeners will definitely benefit from kind of adjusting their mindset to thinking about where they want to be and how they want to get there. So let me ask you this. Where can our listeners find out more about you and Vernonville?
Oh, absolutely. Bear with me because I know Vernonville is a funny name, but I'll spell it out. So it's easy to email me at Eric, ERIC, at Vernonville.com. And let me just spell that for you. Vernonville is V as in Victor, E as in Eric, R as in Robert, N as in Nancy, O as in Octagon, N as in Nancy, V as in Victor, I as in Indigo, L as in Larry, L as in Larry, E as in Eric.com. So Vernonville.com. And you can just go to Vernonville.com. Or you can just Google my name, Eric, ERIC, Tait, Tait. I'm sure I'll come up in myriad ways. So easy. And then if you wanted to call the office, it's 1-877-668-3311. Again, 1-877-668-3311.
Perfect. And we'll put a link to your website, your email, and your phone number on the show notes so any of our listeners can just easily access it there, or like you said, Google you as well. I want to thank you, Eric. Really great information, great advice, and we look forward to seeing what's happening with Vernonville in the future. I'll definitely come back and check in with you in a few months and see what's new and exciting up there.
Okay. Well, I appreciate the time. Hopefully this has been helpful for your listeners. Again, we just try to add value to the world as much as possible.
Awesome. All right. Okay. Thanks for listening to another episode of the Dr. Money Matters podcast. I want to thank Dr. Eric Tait for being my guest. I hope he inspired you to analyze your own mindset about your investments and your financial future as a healthcare professional. Eric has a very well thought out philosophy, and I appreciated getting to pick his brain a little bit about how he achieved that philosophy. So ultimately, for myself, I still will lean towards simple investment approaches, but I do enjoy learning about the different options out there. Eric's company can be found at Vernonville.com, and I'll put a link on my show notes. And he recently started his own podcast called The Physician's Road, which will also be linked on the show notes. Please be sure to check it out. Please let your friends know about this podcast by sharing it on WhatsApp or any social media that you're on. And again, please join our Facebook group at Dr. Money Matters. And remember, this show can be found on Apple Podcasts, Google Play, Stitcher, and YouTube now. And you can follow us on Twitter at Dr. Money Matters and on Instagram as well at Dr. Money Matters. So thanks for listening. Please support all of our fellow physician podcasters, including Eric now, and leave all of us positive reviews on iTunes. It really helps get us to move up higher on the iTunes ranking list. So thanks again, and another episode will be coming soon.